Hello, I'm Joss'n, and welcome to the Financial Statement Presentation. So this is going to be a crash course into financial statements. We're going to go over the income statement, the balance sheet, cash flow statement, and financial ratios. So, income statement. An income statement is basically a financial summary of the company's operating results during a specific period. It could be quarterly or monthly. Usually for quarterly purposes, we prepare quarterly reports for reporting and tax purposes. And then monthly reports are computed by management, and we do a mix of both. On this next slide, there's a lot of information, so just bear with. But on the left and even on the bottom, there's a lot of formulas that's used to get the income statement. So the income statement equals revenues minus expenses. A revenue is fees earned from providing services or products sold, like sales revenues, etc. Expenses are the cost of doing business, or the reduction in value of an asset as it is used during a generate revenue, like wages, expense, utility expenses, etc. And on the right, you can see like an example of one of the statements from the Bradley Company income statements. So you can see how there's a sales revenue, cost of goods sold, operating expenses, all that good stuff. And then you see how we had it from 2012 and 2011. The balance sheet. So a balance sheet is used to summarize the firm's financial position at a given point in time. Usually, statement balances are used for the firm's assets, which is what it is owned, like what we own, against its financing, either through debt, what we owe, or equity, which is what was provided by owners. So a better way to see all this is on this side. So of course, on the right is an example of one. It has its assets and the liabilities of stockholders and equity. And the formula is on the left. So the formula for a balance sheet is balance sheet minus assets equals liabilities plus stockholders' equity. And on the right, you can see how the assets are on the top and the liabilities and stockholders is in the bottom. So assets. Assets are any item or economic value that can be converted to cash, like in the future or even now. And of course, cash accounts are some examples. Liabilities are debts and obligations of the business that they represent as creditors claim on business assets, like a mortgage or anything that's known as payable. And then stockholders' equity represents the interest of a company's shareholders in the net assets of the company, which can equal to the excess of a company's total assets over its total liabilities, which can be like retained through earnings or common stock or paid in capital. And on the right of this chart, you can see how the assets shows like the cash, land and buildings, machinery and equipment. Basically, that's what can be converted, anything that can be converted into cash. And then the liability on the bottom shows how the accounts payable equals to all that. So a cash flow statement. A cash flow statement is basically like what comes in must come out kind of deal. So it provides a summary of the firm's operating investment and financing cash flows, which is like cash generated and used, which is in and out. It reconciles them with changes in its cash and marketable securities during the period of inflows, during the period of any time period, usually within the year. And of course, in parentheses, I'm showing like the inflows and outflows in and out during a given time period. And it ties together the income statement and previous and current balance sheets, which is what we went over through balance sheets. And there's three kind of categories that happens during cash flow statement, which is operating activities, investing activities, and financing activities. And operating activities is cash provided and used in normal percent operating activities, such as current assets, which is counts as receivable, and current liabilities, which of course like is anything that's payable. And then investing activities is purchases of a long-term assets, such as property, plant, and equipment. And then the financing activities includes purchases of bonds and stocks and dividends. So those are the three categories. And again, as you see in this slide is an example of one, and it in the bold, you can see how it's broken up in three categories: the operating activities, which is the profits after tax, increase in accounts receivable, decrease in inventories, accounts payable, like I said earlier, And then the cash flow for investment activities is anything with increase in gross fixed assets, change in equity investments in other firms. And then cash flow and financing activities, that's decrease in notes payable, increase in long-term debts, changes in stockholders' liquidities. And if you just look it out, you can see how it's broken down in the chart. So the last thing we're going to go over is financial ratios. And there's a lot of info that goes into financial ratios. This is just like a very intense crash course, and I'm not going to cover all the information. But basically, financial ratios involves methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance, usually against competitors. You want to compare where we stand compared to other companies. And interested parties are usually current and prospective, creditors, and management. And the 5 categories, which there's a lot of info that goes under all of these, but the 5 categories is liquidity, activity, debt, and profitability. And liquidity is the ability to satisfy in a short-term obligation, usually within the year. And then activity is the type of ratio that deals with inventory turnover, average collection period, average payment period, and total assets turnover. Debt ratios indicates how effective the company is using other people's money to generate profits. So times of interest earned is part of that ratio. Earnings before interest and taxes would be found during this debt ratio. Profitability ratios is the gross profit margin that measures the percentage of each sales dollar remaining after goods have been paid. And that deals with operating profit margins and net profit margins. And on our next slide, you can see an example that breaks all these down. So the first one they show is liquidity, and it has the current ratio, and it shows you the formula, and then the years from 2010 and on in the overall. And then it's the activity, and it shows the inventory turnover, the collection period, the average payment period, and the total assets turnover, and of course the formula, and then from the years on the right. The debt ratio, times of interest earned ratio, fixed payment covered ratio, the formula, and then some of the numbers from the years on. Profitability, which is the profit margins, operating margins, and the net profit margin. And last but not least, continuing really, is the profitability, which is earnings per share, return on assets, and which is the ROA. And there's a lot of information, but this is just an example just to get an idea of what it is. But this concludes the financial statement presentation. It was a very crash course example. Hopefully you understood it. If not, we can definitely do another presentation. But here are my references. I used the Principles of Managerial Finance, and I had some of the photos from Pixel. And of course, I used a T. Merkel's video blog post. But thank you. Thank you for listening to my presentation.